Hello and welcome to another episode of NIPFP's Golden Jubilee podcast series, where we bring to you conversations with experts, academicians, and practitioners on issues related to macroeconomics, public finance, public policy, and Indian economy. For today's discussion, I would like to begin with a remark by Geoffrey Hinton, who's widely known as the godfather of AI. When asked what might be a good career choice in the age of artificial intelligence, he reportedly responded, train to be a plumber. Well, irrespective of whether you agree with that remark, it captures a deeper anxiety of our times. What kinds of jobs will remain secure and meaningful in this rapidly changing economy? Now, this question has become even more urgent in today's uncertain global environment. Besides AI, we are facing the geopolitical tensions in West Asia, leading to the price energy volatility, rising sovereign as well as household debt globally. A fragmented and multipolar world order is what we are seeing emerging in front of our eyes, and also the associated risks with climate change. These uncertainties have a direct bearing for growth, for unemployment, inflation, and of course affordability. To help us think through these issues, we are delighted to have with us Professor Amartya Lahiri. Professor Lahiri is the Royal Bank Faculty Research Professor at Vancouver School of Economics, University of British Columbia. He has also served as the director of CAFRAL, which is an independent think tank and research institute established by the RBI. And he has also experience working at the Federal Reserve Bank of New York. So Professor Lahiri is also well known for his extensive work in international macroeconomics, growth and development. And of course, his huge list of publications in leading international peer-reviewed journals. His recent work speaks directly to many of the questions we are going to pose today, which will be around jobs, India's development strategy, inflation, and of course, sustaining growth in these uncertain times. Professor Lahiri, it's an absolute pleasure and honor to have you on the podcast.
Thank you for having me. It's a pleasure being here.
The recent PLFS monthly data show that India's unemployment rate for persons aged 15 and above stands at 5.2% as of April 2026. But the bigger issue is, of course, about the nature and the productivity of work. And at this point, I would like to draw on your work with Devashish Mitra on India's development policy challenge, where you discuss manufacturing, exports, employment. Now, India has continued to grow rapidly, but concerns remain about the quality of employment and whether enough productive jobs are being created. So my question is, what, in your view, should be the key pillars of India's development strategy over the next decade, let's say?
That's a sort of a wide canvas to address, but I'm just going to pick it at a different level. So the first up, I think because you mentioned my work with Devashish on this, and one of the things that we found somewhat surprising, given the entire narrative that exactly along the lines that you mentioned just now, is that India's workers are just not productive enough. And so one of the things we saw was that if you just looked at labor productivity broken down by industry in the export sectors, actually India's labor productivity lines up reasonably well with places like Vietnam, with Bangladesh, etc. It's just that we don't have. So it's not as if Indian workers cannot compete. It's just that we don't just have no scale in any of these sectors. So it was a bit of a surprising finding for us that if you just looked at worker productivity broken down by sector and just compared labor productivity sector by sector with our comparator countries like, as I said, Vietnam and Bangladesh, who have been constantly compared with us. It's not that Indian workers are not just, laggards over there. They actually stack up reasonably well. So I think the bigger challenge is understanding why is it the case that we are not able to scale up these kinds of jobs,
Right.
and which is related to the other part of the question that you asked, that how come we are not able to, what are the jobs that are being created, and why, we don't seem to have good jobs. We have, a preponderance of gig worker jobs, but we don't seem to have the jobs that people would like to have, which is, and that's where I think the question then comes back to this issue of something about our industrial space limits how entrepreneurs and firms behave over time. There is a great reticence to grow of Indian firms. And of course, you can't really create a whole lot of jobs. So if everybody stays small and you're trying to, a median size of between, 10 to 15 or 19 workers is where a typical Indian firm is operating. That is not creating enough jobs at scale, because you'll need lots of startups of manufacturing firms in order to be able to absorb all the new workers that are entering. As you said, the median age of the population is very low. We're adding close to about 10 million a year to the workforce. So that's a huge number that's being added. Now, for them to get absorbed, if all our manufacturing firms are just going to be absorbing them based on just new startups of 10 workers at a time, you need a massive expansion of firms, new startups. That's just not happening. So what's going on is you have very few firms that are growing. That there is this scare of growing if you're a brick and mortar business in India, and so we just see very tepid growth there. And a lot of the older manufacturing firms that were in the export space are just holding their positions. They don't. The expansion seems to be very limited. And so it's a challenge to absorb workers if firms are not growing. So then it pushes the question to someplace else, that what is holding back Indian firms? Why are Indian firms behaving the way they are? As I said, I don't think it's all productivity of workers, that these are all poor. I mean, there's something going on in the space of the business environment, which in some sense makes firms fearful of growing. Is that because of uncertainty about the business climate in the future? Is it uncertainty about the regulatory structure? Is it uncertainty about global conditions? There's a whole set of things that you also brought up quite correctly. But that's where the challenge is. I think
so the ecosystem for the startups, you think, might be a good space to kind of focus on?
But it has. I guess what I'm trying to say is that just to rely on startups is just putting too much, because you just need massive amounts of startups to be able to absorb all these people. And startups not of app-based, the service sector businesses, but more about startups in brick and mortar stuff, because they are potentially are better paying, more productive jobs, as opposed to the typical gig worker jobs. Those jobs are somewhat better, but they're just not creating enough. So this comes back at the end of the day to the debate that has been going on in India for 20, 30 years now, which is the role of manufacturing versus the role of services. So we've had lots of debates about this, that can India have a growth path, which is sort of sui generis in some sense, that we just grow on this on a path which is service led as opposed to manufacturing. And the problem is that the manufacturing, the service sector in India is so bimodal. I mean, or it's really two sectors. Most value added in services is produced out of 3 or 4 cities, and most employment is produced at a very different, which is spread out all over the place. Those value added producing service sectors don't actually create that many jobs at the scale of when you think about India. while so services share of employment and services share of GDP is both rising, but the employment is mostly being created by extremely low value added, there's the gig worker stuff. And the GDP growth is really concentrated amongst firms that are not really producing that many jobs.
Right.
And so we have a contradiction here, which is where it, runs into the direct challenge of dealing with the demographics. That if you are producing lots of people who are joining the workforce, to have a setup where not enough jobs are being created in the service sector at a level that meets the aspirations of those who are joining the workforce now, because they're not uneducated, these are not primary school dropouts and so on. Most of these kids who are joining the workforce now have like 8 to 10 years of education, so they have come out with greater aspirations than their parents and their grandparents did. So if you cannot absorb them in jobs that meet their aspirational levels, this demographic dividend can turn into a bit of a nightmare, because you have a whole bunch of very dissatisfied young people, and that is socially actually as well very, very problematic, that you can't have so many disaffected people.
Right.
And so it's incumbent upon the economy that I think that we need to be able to create higher value added jobs. But the service sector has a limit about where you're going to produce these high value added jobs, because the service sector high value added stuff is very high white collar, high skill. Most of these Indians who are joining the workforce don't have the requisite skills to be, even, I mean, we can quarrel about what skills the STEM graduates have, but I'm leaving that aside.
Okay.
But just somebody who has 8 to 10 years of education, they're not going to be employed in Infosys, they're not going to be employed in the...
Right.
So then it becomes this question of where are the relatively better jobs which will meet somewhat their aspirational, desires.
Right.
Where would those kinds of jobs, more likely, are more likely to get created? So I just don't see the service sector being the one that could do that.
Okay.
It has to be the manufacturing sector has to play the role. Otherwise, it's going to be the case that it's either you stay on in agriculture, or which is really hidden unemployment, or you become a gig worker in some urban, peri-urban setting. And that just is, both sets are very unhappy.
Right. Okay.
And so that's where the challenge, I think, is.
Right.
That manufacturing has to come to the party in some sense.
Great. Yeah. Thank you. That brings me to another related question. So, whether India can benefit from the China plus one supply chain diversification. So, do you think manufacturing and exports can still become a major engine of employment intensive growth for India, or has the global window for that strategy narrowed?
I think the global window has narrowed a little bit. What China could do, I don't think we can do anymore. Right. The nature of the business has changed. So the global value chain, I think, so first up, I mean, I think the Chinese model was more, it was bidding for business on, or actually the Korean model was about sectoral specializations. Now we just have to get much more into this business of bidding for business on components, stages that, and so if you can find a space in this component, global value chain assembly system where your specialization has cross-industry spillover. So if you can find things that I'm doing with, I can do some things with, computer chips, but I can also be, that same technology or the same skill is also useful in motor parts. And so we need to find that kind of
sweet spot
where
of innovation where you can.
But so you can scale up and be relevant for many different industries,
right.
as opposed to just being. So that's why the whole semiconductor business is sort of so because it's used almost everywhere.
Right.
So it's almost like you have to go up, scan the input-output structure, and say, here is a segment in the global production chain which is central to many different sectors, and bid for business in that part of the global value chain in the upstream downstream linkages. So I think that is, I don't see why that is not, has gone out the window. But there is also a short, medium term versus a long term issue here about what India, in order to be relevant in these fields, in these sectors, if you are not going to just be a component assembly group that I just import parts from somewhere upstream, I kind of pick them all together and I ship out phones, I didn't really create any jobs because those things were very, very limited and it didn't create, So we need to move up the value chain in this. And so that's where I think human capital and training, which you brought up earlier, I think is extremely important. That we need to be doing manufacturing and encouraging manufacturing in the short to medium run. But at the same time, there has to be a much more concerted effort at skill building, of Indians, because we have to be moving up the value chain, because we cannot be competitive in this business unless we also have the training. And so the part of the problem is India's educational structure right now is struggling a little bit to, and I think it's just an issue. It's not just an issue. It is an issue of the system getting swamped by just the demand side. I mean, we are a large country, and so as a result, producing schooling infrastructure at scale and higher education infrastructure at scale is a big challenge, because it's not easy to do it. And then, of course, it's not just about putting together buildings, and it's also about who are the people who are going to be, what are you going to be teaching them? And so that requires personnel. And so that personnel retention. So it requires a concerted input and effort in across the board, where it can't be just one actor doing it. So it has to be like the states, the center, and more decentralized organizations, the private sector. Everybody has to be playing a role here, because that, I think,
bring them on the same table and then have that discussion.
So I think this is where I think the bigger hurdle of moving forward is this, that in order to be relevant, whether it's global capability centers or and all of that business is also because AI is going to threaten that. But without education, we're going to be with relevant education, we're going to be in serious trouble. So I think that is where the immediate issue is manufacturing, and because those high value-added white-collar jobs are the ones that are actually immediately under threat as well from AI.
Absolutely.
So that is another reason why one should be a bit leery of getting too deep into the service sector side, because the service sector side that is immune from the AI business is just personal services. That really doesn't, and so that is not threatened by AI, but the trades are not threatened by AI. So that's the quote that you started with, which was really nice. But so those things are immune, but everything else in the high skill white collar sector is so that's why manufacturing becomes even more important. That we have to.
The focus should be there. Okay, moving on to somewhat similar issue, but of course important. So India's recent growth has been supposedly significantly thanks to the public capital expenditure. But for growth to be sustained, private investment, exports, and productivity growth also need to be strengthened. So my question is, how should India think about moving from a government capex-led growth impulse to a broader, more self-sustaining growth model?
Yeah, I think, we have to, the private sector has to start investing. I mean, we cannot sustain our investments solely through public investment. And that unfortunately is where we've been stuck for the last 5-7 years. That's what's been going on. And it's a bit of a mystery as to what is, because all other indicators seem to suggest that the economy seems to be robust. Growth has kind of been high. Our foreign exchange reserves used to be relatively high, but the part that seems to have been, not really picking up is private sector investment, and FDI flows have turned around as well. The FDI flows, you can kind of say maybe global conditions have something to do with it. But why private investment hasn't taken off, you cannot blame global conditions for that, because these guys are just sitting on cash and rather than investing. So you have to ask, there is something. I mean, it's futile to sort of blame the private sector saying you're not doing your job. They are following their profit instincts.
Well, it's an uncertain environment, so even that kind of hinders.
But then the question, I mean, so as I said, it's been going on for like 6, 7 years.
Right.
I mean, we've been stuck. I think no contemporary miracle country that we looked at over the last 50 years has achieved that kind of breakthrough from poor to high middle income status without spending 5 to 10 years, sustained saving rates over 40% and investment rates over 40%.
Wow.
So, I mean, at least the upper 30s. You have to sort of consistently for a decade do 35 to 40% savings and investment. We have been stuck with saving rates that are around 29, 30%, and investment rates are actually even lower, and investment rates that were stuck around 30% despite the capex. So now you have to ask that what exactly is going on. It's like we are, the private sector, everybody's just holding pat. It's like an economy that seems to be, not moving. And yet we have these growth rates that which is just suggesting something about somewhat skewed growth, which is the other concern. But getting back to the question about how, how to get India Inc. to the party in some sense, it has to be the case that, they have, I'm guessing, legitimate concerns. Some are related to regulatory uncertainty. Some are related to taxation norms and uncertainty about longevity and stuff. I don't know how much of that is, just in their minds and how much is real, but it has to be addressed. That this concern that this is it's an uncertain business environment, and so that part I think is a key component that has to be dealt with, because without that we just cannot have the government driving everything.
Right.
And related to that, I think there is this second aspect, which is in terms of what is preventing growth of existing firms. So, which is related to this investment issue. That if you talk to, which I have done a little bit, talk to exporting firms, and including the biggest exporters in India. And one of the common themes that you keep hearing about is the fact that labor laws are limiting stuff. Now, there are there have been some changes to the labor codes. We've collected them into 4 different codes, and so there's a lot of streamlining. But those laws haven't gone away. I mean, so the big thing that we did was move to 300 as opposed to, in terms of firing. But, I think we need to be a bit more aggressive in that and say that, hiring, firing should not involve regulatory approvals, until maybe you've reached the 1,000 stage. And then above that, just 300 is also too limiting. I mean, because we need bigger firms. I mean, so if you just look at the apparel and textile industries, in our competitor, Bangladesh or China, if you look at the biggest firms in Bangladesh, they employ 5,000 to 6,000, workers per factory. Yeah. Our biggest exporter is like Shahi Exports, which exports a lot of, is the biggest Indian textile and apparel exporter. And their factory, the mean factory size is about 2,000. Yeah. Even though they employ, 125,000 people. But it's spread out over 55 factories. So they're about 2,000. They don't want to go beyond that. So you have to ask, even if these biggest, people are shy of, so you can imagine there are well-defined constraints, because so this is something that one really has to sit down and we've kind of sort of got a bit stuck here that, each person is pointing at the other person. One says business uncertainty, the other says the capital, private sector isn't investing. But there is obviously a friction somewhere here that people are perceiving something and it's their money. So, I think this has to be fixed, whether it's the taxation, whether it's the labor laws, whether it's the regulatory environment otherwise. And similarly with FDIs, that, we had the bilateral investment treaties which got rewritten, and it pushed the burden a little bit, or raised the risk for foreign investors as well, because of arbitration. You are not allowed, you have a 5-year cooling off period. And so all of those things, I think, did have a negative effect. So this has to be, we need to really work on this to get that investment side organized. You cannot rely on capex.
Right. Okay. That brings me to another related issue that we're all facing right now. The rupee has recently come under pressure. And Reuters reported that the RBI resumed aggressive pre-market intervention on May 21st, 2026, after the rupee approached record lows near 97 rupees to a dollar. Now, in your work on inflation targeting and exchange rates, you examine how exchange rates behave under inflation targeting regimes. So my question is, what lessons does this hold for emerging economies such as India, where rupee movements, oil prices, capital flow volatility, and inflation expectations are closely linked?
I think, let me just take the first piece, that the rupee has come under pressure.
Right.
But the rupee pressure actually is an ongoing thing from, I just take a very simple, in December, I'm going to take you back.
Yeah.
So December 31st, 1999.
Right.
The Indian rupee was trading at about 42, 43 rupees per dollar. Yeah. What has happened since is, if you just look at how competitive must Indian goods be in order to balance the current account, you cannot be losing ground in terms of your prices if your prices are rising faster than your in competing countries. So in India, our average inflation rate from from 2000 to 2025 has been about 4 percentage points higher than in the US. That's the average, yeah?
Okay.
So 4 to 5. So if you just take 4%, so in order to, if Indian prices are rising 4% faster than US prices, the only way you can maintain competitiveness is if the exchange rate compensates by depreciating to kind of undo this relative. So the exchange rate kind of has to depreciate at about 4%, 4 to 5% a year in order for India to maintain its relative competitiveness, for the current account not to worsen, right? That's what. Okay, so now you just say, I'm going to compound at 4.5%, 5% over 25 years, starting at 42. You'll end up close to 110. So, so that's just applying this very baseline thing. And so that comes back to how is, the rupee movement happening. So, of course, when a current account imbalance, if I'm exporting if I'm exporting less than I'm importing, then there is a payment imbalance that, I have excess demand for dollars. That can be met in in 3 ways, right? I mean, so on the one hand, it could be that I have, net capital inflows from outside because my country is very attractive to foreigners, so they're going to invest. So that's just autonomous capital inflow, so that can undo some of this. So if there is a 2% current account deficit and we have FDI flows or foreign capital flows of 1.5%, 2%, 1.5%, then the gap becomes 0.5% of GDP. So how do you finance 0.5%? It can be of 2 ways. Either the government is, if the RBI is sort of selling some reserves that finances it, or you let the currency depreciate a little bit. We've been kind of doing the latter bit. I mean, in fact, we have allowed the currency to depreciate a bit faster. So as a result, the RBI has actually been pulling in some reserves in the process, that imbalance. So those are the 3 ways you do this. So now all of a sudden, if you previously getting 1%, 1.5% inflows, and that kind of dries up. So your deficit, and at this point, suddenly you're going from 1.5%, 2% to it's going to go to 2.5%, I think. And so as a result, you have suddenly a gap that has opened up, which is much bigger than 0.5% of GDP.
Right.
So how do you finance that? India has been, you can either allow the rupee to depreciate, or the RBI can keep intervening to try and sell off dollars to prevent it. There's a limit to how much they can do that.
Right.
And so this, at the end of the day, comes back to this current account deficit. So why is it the case that we are not, if you run current account deficits and you have, and the flip side of this is, we are not being competitive enough. So our prices are rising a little faster.
Right.
And so as a result, the currency is always under pressure. And so the way the RBI deals with it is that it kind of keeps so it's like a step function almost, that if you go back, you just plot the rupee against the dollar, it's just like this. It goes up, and then, so it went from, we try to keep it under 50 with gradual movements, and then at some point you kind of let go, and it goes to 50, 55, 50, and then you sort of, again, it's 60 is a psychological barrier.
So you're always at the steering wheel.
Yeah, so you're always at the steering wheel, and it's kind of gradually going up, then you kind of prevent it from going. So you go, so 60 is the new barrier. So once you breach that, then you kind of stay between 60, 65, and the pressure is still there. And then at some point it suddenly goes to 70. So it was, if you even go back to 2017, the exchange rate was 65. Then, by 2019, it crossed 70. And you went, so that's how it's been going. It's like the RBI prevents it from discrete changes, but every now and then there are shocks.
Right.
So this is like you imagine a pressure cooker. There is steam that is, the cap is on, the steam is inside. And every now and then you have to, so you can try to keep the exchange rate under control by the RBI keeps the cap on.
Right.
At some point the pressure becomes high, so they let it go. But the reason they have to let it go is because there is pressure, and that's coming from the fact that Indian inflation, on average, has been 4 to 5% higher than the US. It's just.
I see. Okay. So, drawing on your work on the central bank's dilemma, look through supply shocks or control inflation expectations, how should central banks respond when inflation is driven by supply shocks, such as food, fuel, or global commodity prices? And at what point does looking through, within quotes, such shocks become risky for inflation expectations?
Yeah. So essentially, there are, inflation expectations are a key component of inflation.
Right.
So, it's inflation, clearly there is this, the channel that we always think of as the first level is trade balancing off demand and supply. And so if the demand exceeds supply, then prices tend to rise, and that's the inflationary pressure. That's how we normally think of it. But this aspect, also these inflation expectations, become a key component. That's an additional component to how inflation moves. It's not just demand and supply, but there is this expectational margin. And that is because anytime we are setting prices of our own labor, of our own goods, we have to form some sort of expectation, because lots of contracts are not just spot market contracts. I write a contract, I'm going to receive delivery in a month or 2 months or 3 months. And so I need to take into account what this, the number of rupees I'm going to get in 3 months' time, what the real value of that is relative to what I paid in order to produce the good. So I have to form expectations in order to price a good appropriately.
Right.
And so that is about expected inflation. So a big driver of inflation is expected inflation, independent of what's going on in demand and supply. So even if demand and supply are relatively in sync, if expectations become de-anchored, you're going to find this kind of spillover, that as firms begin to raise prices, wages, start rising because, they see cost of living is rising, and then it starts feeding off, and then it takes off. So managing expectations is a hugely important thing. Now, you come back to what monetary policy can do. It is essentially in the short run, when inflation suddenly spikes, monetary policy works by changing, just by changing interest rates, you're kind of making investment more expensive for firms, you're making consumption more expensive for consumers who are willing to borrow to finance stuff. And so you're depressing aggregate demand. That is the first line. And then, if in as much as investment, responds over time, it will create some supply effects down the road, but that's not immediate. The supply side of investment changes are down the road.
Right.
So what happens immediately is just a demand side effect.
Right.
And so is that going to be, you have an instrument which is going to hit the demand side, and you're trying to address a problem that has come from the supply side, which is what happens with fuel price shocks or a drought condition or something like that. Food prices go up. It is not to do with demand. So in those worlds, if you try to reduce inflation by tightening policy, if anything, it's just going to reduce demand even more, and that's going to make the output collapse much bigger. So correcting inflation,
has a cost,
which has come due to a supply shock, by shrinking demand, is just going to make the supply side, make the recession bigger. So that's the dilemma for a central bank, because their instrument is something that really is a demand side instrument. So the appropriate way to deal with it is if they had an instrument that could affect the supply side to offset it, but that's not the instrument they have. So one option would be not do anything, because this is the wrong instrument. I don't want to make things worse.
That's your looking through.
That's the looking through. So then you can say, and that's indeed how I think all after COVID, when the world kind of opened up, all of a sudden there was excess demand for shipping and there were just not enough ships. And so we ended up with a complete gumming up of supply chains around the world, and prices started shooting up. And so at that point, a lot of industrial country central banks, basically, inflation was rising and people are saying, what are they going to do? And they kept coming, the governors and the presidents of these central banks were making statements saying, these are just supply related things, it's going to go away. We are going to be looking through them. We are not going to do anything. And then at some point, they, after 6 months or 8 months of this, rising inflation, they suddenly changed their tune and started tightening very rapidly. And the story at that point was exactly this inflation management, the expectation management, that we are worried about de-anchoring of inflation expectations, because people do set their expectations based on what they're seeing. So if we let this this inflation keep ramping up, people will keep expecting worse outcomes in the future, and that will then become much harder to take out from the system, because all prices are going to have that embedded in it. And so that's the wage price spiral. And then it becomes much harder to disinflate an economy if the wage price spiral kicks in. And so that's all through expectations. So then so there is this issue of how long. So the central banks pivoted at some point. But how long should I wait before I do this? Is there like some way of thinking about an optimal threshold of some sort of waiting time before I act? And that's this paper that you described, that we try to provide some structure to this. That is there some way in which you can think about how long to wait, and at some point, so because it's trading things off. Because if you act right away, you'll kill the output side of the economy, because you'll create a much bigger recession, and that's costly. So maybe you're looking through for a bit before you act, and that's very, very relevant for countries like India, because even without this oil price shock we're going through right now, because India's food and fuel share of expenditure is 45%, 44%. So we rely a lot on these. Our typical consumers, has a huge weight of food and fuel, and this is mostly food and fuel prices move around mostly due to supply shocks. So sometimes, over which India has little control. You don't have much control over the monsoon. You don't have much control over what's going on in OPEC pricing and so on. So you just inherit that. And then how do you manage it? So, but you, again, for the Monetary Policy Committee is facing this all the time, that, you have inflation suddenly shooting up because the monsoon failed. Should they act? Should they not act? So this is sort of for emerging economies where people's, budget has a much bigger share of food and fuels. This is an ongoing issue all the time. The industrial countries are facing it now, but in emerging economies, it's a pretty regular event. So I think, that's one of the reasons why, I think this work was, to me, I think important for emerging economies to understand that, the way that developed countries operate in terms of monetary policy should not be the same way that emerging economies approach managing monetary policy. You have to be much more aware of which shock has come from the supply side and which shock has come from the demand side. And for supply side shocks, it is often optimal not to start responding right away to what's going on with inflation.
Okay. Interesting, again. Talking about inflationary expectation, there is a broad literature out there which talks about monetary and fiscal policy interaction affecting or helping anchor the inflationary expectation. So even if monetary policy is trying its level best to sort of, rein in the inflation, but if fiscal policy is not doing its bit in terms of anchoring the expectation regarding what the primary surplus in the future is going to be, then there could be impact on the price level. So let's say even I, as an economic agent, I'm looking at what the government is doing in terms of the taxes and the spending before I can make that choice about consumption and saving. So my question is, when we look at these models of inflationary expectation, rarely do you see the fiscal policy featuring in those equations. So I'm just curious, should we think about bringing in the fiscal side as well, and the monetary authority should take into account what the fisc is doing much more seriously than they think about, because monetary policy alone will not be able to succeed in even keeping the inflation at its target if that commitment from the fisc is not coming regarding what the primary surplus going forward is going to be. So your take on that?
I completely agree with you. I think it's a hugely important thing. This goes back to this literature on fiscal dominance and so on, that there are really these two agents, and the budget is, the consolidated government budget has some part that is controlled by the monetary authority, some parts that are controlled by the fiscal authority. And in some sense, who is the residual, mover, who is going to balance the budget, determines a lot about what, how the private sector is going to, proceed, what's going to happen. So if the fiscal authority is the one that is basically laying down the law, I'm going to spend X, then that government budget has to balance. So either the central bank will sort of take that on board and choose money, money injections to keep that together, or the price level will just move around, and that's the fiscal theory of the price level. So it just comes down. At the end of the day, there's just a budget identity. It's the consolidated government. It has to hold. So this becomes a pretty. So one of the things that, India, let's take India's example. India has done, inflation was routinely, in double digits in the late 2000s, between 2008 and 2013, or 2007 and 2013, 6 years. India spent 5 out of the 6 years with double-digit inflation rates. So very poor inflation management at the time, but also period with high deficits, fiscal deficits. So one of the things that, and then inflation rates have come down, they came gradually down. A lot of that is attributed to the change in the monetary policy regime, that going to inflation targeting, that, it helped anchor expectations and all of that. But I think the less recognized, but possibly even more important reason for why was this government, over the last 10, 12 years, I think the fiscal management has been a whole lot more conservative relative to what we used to have before. And that is, I think, a much big, an equally big, if not a bigger reason why India has managed to disinflate. And that addresses directly what you're saying, that the fisc is extremely important. That in order to understand it. But you're sort of taking me back a little bit about, this goes back to questions. So I've done some work on trying to understand what happens if when countries raise interest rates, does the exchange rate appreciate or depreciate? And it turns out that, it almost seems like a very basic question that, if the RBI raises interest rates, should the rupee appreciate or depreciate? I mean, and people have we teach things to our undergraduates and so on. The data is all over the place.
Okay.
So it's not the case that, that
right.
it always appreciates.
Right.
And it turns out that in developed countries, it tends to appreciate. When their central banks raise interest rates, their currencies appreciate. In emerging economies, when interest rates are raised, their currencies depreciate. And so we dug deeper into this, and there's a little structure and so on. But at the end of the day, what the evidence was, the places where it depreciates in emerging economies, it's the fisc that seems to be dominating, and so the absorbing authority becomes the monetary guy. That's where it depreciates. While in the countries where the monetary authority is an independent, it sort of moves first and it says, that's what I'm targeting. Raising interest rates tends to appreciate the currency. Again, very important that's an excellent, very important question you've asked, and the fisc is really very important.
Thank you. Okay, moving on to our next question about global savings investment, and this is again drawing from your recent work on explaining world savings, which speaks to broader questions around saving investment, demographics, and capital flows. So, for an emerging economy like India, how do global saving patterns affect the ability to finance investment, infrastructure, and public debt? And a related question is, should policymakers worry more about the level of debt or about whether borrowing is being used productively?
So global savings, I think our global saving cycles will have implications for any emerging economy. India is no exception, because we need, as I spoke about it earlier, that if you're running a 2.5% current account deficit, you have a financing gap.
Right.
And so at the end of the day, a current account deficit is also a saving investment imbalance. So our savings are not enough to cover, our domestic investment. So we need these foreign funds.
Right.
So anytime global savings go into a crunch, so if there's a global recession, global savings are going to be falling. And at that point, you will have a bit of a financing crunch. So if you are running sustained current account deficits, you're going to be more exposed to these kinds of, or more sensitive to these kinds of global saving cycles. And you face the heat. And so we are clearly, so India's exposed, and actually all emerging economies are, because they tend to be the ones that run these deficits. And so we are we are sensitive to it. Now, it's the nature of the beast. You want to sort of try to smooth it out as much as possible. And one way, that is a policy goal that I think all countries should have is somehow to try and distinguish yourself in the eyes of the international lender, these international banks, etc., that they tend to put countries into buckets. Right? So there are there's the high risk, there's the middle risk,
ratings,
and there's the low risk. And so most developed countries fall into the low risk. So they're more the AAA, the BBA, and so on. And then the emerging economies often get clubbed into the junk bond category, and that's how it is. It's not. I'm not talking about it. I'm just talking about emerging markets in general.
Right.
Indeed, I mean, emerging market bond funds are very highly correlated with junk bonds. US. So from a portfolio manager's perspective, what they are doing is basically they're trying to manage a portfolio where they're trying to maximize returns and try to minimize risk.
Right.
So there is a tolerance level for risk, and there's a desire for high returns, and you're trading that off. So if suddenly the world, capital markets come under stress, maybe due to a global cycle, saving cycle that has turned tight. Now they're seeing that rates are rising across the world. So there is an incentive to start moving, because the emerging countries are in this riskier pool. So you could potentially start moving funds out from there and put it into the safer group. which are the emerging, which are the developed countries, you reduce the overall risk, and you're not really losing too much in terms of returns because the rates are going up. So the only way to counteract that is by raising rates yourself. But the inevitable first impulse in emerging economies is, in amongst the international creditors, is to rebalance their portfolios at that point, at these points, because they find that these periods of global stress are also periods where these emerging economies look more risky, because they are more sensitive to these flows.
So it's more of a flight to safety.
So it becomes a flight to safety, and so they start pulling funds out across the board because they've clubbed everybody into one
That's
big
what we're
bucket.
seeing currently as well.
Yeah.
Might be that is one of the reasons.
Yeah, so and that's just, if you are a portfolio manager sitting in Manhattan, that's how you would behave as well, saying that, okay, I have my risk categories and I have to rebalance. These guys are suddenly looking, the world is looking more risky, so I have to reduce my overall risk exposure. So I need to take stuff from the high risk bucket and put a bit into the low risk bucket, and that way but what I take out from the high risk bucket, it's just across the board. It's just, Nigeria, Kenya, India, Brazil, they're all in that one bucket. So everything gets pulled out. The challenge is to distinguish yourself, saying that when they pull stuff out, I don't get clubbed together with everybody else.
Great. That's a great point you made.
And that is the challenge about, so this goes back to how attractive India looks to foreign investors. So we have to work harder to make it look attractive for them.
To stand out. The Union Budget 26-27 targets the centre's fiscal deficit at 4.3% of GDP, and it is down from the revised estimate of 4.4% in 2025-26, and estimates central government debt at 55.6% of GDP in 2026 and 27. So that's kind of the fiscal side of it. Now, given that our bread and butter at NIPFP is public finance, so I'm quite, so I want to ask how emerging economies like India should balance fiscal sustainability with the need for growth enhancing public investment. And of course, in a world ridden with supply shocks, in terms of the oil price shocks, changing global saving pattern, as you mentioned, and the climate related investment needs. So how should policymakers really think about public debt, fiscal space, and macroeconomic stability? Your thoughts on that?
I mean, so I guess the way, in terms of sustainability of the fiscal situation, sustainability, of any kind of budgetary outlay, at the end comes down to an assessment of future revenues versus future spending. So the question always has to come down at the end of the day to, am I creating pathways for higher revenues in the future or not? So my current expenditure, which is the source of the debt that I'm generating today, has to create some sort of a clear pathway towards higher revenues in the future. If you see that, you're okay. If you don't see a clear pathway between the deficit today and the revenue path in the future, that needs further thought. So I think you guys are much closer to the fire pit here. So I think, but that's how I would approach it, saying that this 4.5% and 55% debt. The debt level is the debt level. I wouldn't, get, I think that's lower than what. It's an outcome variable. But the flow is something that you can control almost immediately. And so what is sustainable or what is not, it has to be judged based on this deficit is really, what is it financing?
Financing, exactly. Okay. So thank you very much for taking time out of your very busy schedule and for enriching us all with your insights. Thanks once again.
My pleasure. Thank you. Thank you.